So, I want you to imagine discovering this completely empty island, right? Just a barren rock.
Okay.
And you pull out a megaphone and you confidently announce to all your investors that by next Tuesday, this tiny rock is going to have the booming $91 billion economy of like a small European country.
Yeah, man, that sounds like absolute science fiction.
Right. It sounds completely delusional. But today we are looking at these internal notes and transcript excerpts from a CEO who is basically promising the market equivalent of exactly that.
It's pretty wild.
It really is. So welcome into the deep dive. If you're joining us today, you're probably trying to stay ahead of these massive tectonic shifts in the tech and financial markets. And our mission today is, well, it's really an exercise in reading between the lines of some very high-stakes corporate signaling.
Yeah, and we have a really fascinating stack of sources to look through today. We're unpacking these brief but honestly pretty explosive excerpts from a CEO discussing a specific entity. And in our notes, it's just referred to as LITE.
Right, the ticker symbol.
Exactly. And our objective here is to decode this highly specific, very heavy phrase that the CEO keeps anchoring all their projections to, which is the CPO Supercycle.
Yeah, the CPO Supercycle. And I want to set the stakes for you, the listener, right at the top of this. We are looking at a market, this CPO market, that the CEO's own notes describe as currently being, quote, close to nothing.
Barely exists.
Right, barely exists. Yet the total addressable market, or the TAM, is projected to skyrocket to $91 billion.
Yeah.
Like, just let that sink in for a second. From practically zero to a $91 billion TAM. That's the empty island turning into a global economic power overnight.
It is, and the sheer audacity of that kind of projection, it really demands scrutiny. We have to figure out what a CPO supercycle actually is.
That's right, and mechanically, how does a market scale that violently?
Yes, and perhaps most importantly, we need to figure out what the CEO is strategically leaving unsaid here.
Exactly. So let's start with the physical reality of what we're actually talking about here. Because, understanding the tech is really the only way to understand the math.
Yeah, you have to.
Yeah.
So CPO stands for co-packaged optics. And to visualize why a market for this would just, explode to $91 billion, you really have to look at this massive bottleneck that's happening inside modern AI data centers right now.
Well, let me just pause you there because we hear terms like data center bottleneck thrown around all the time, right?
Oh, constantly, yeah.
So what is the actual physical wall we're hitting here?
It basically comes down to physics and, well, heat. Historically, data centers have used these traditional copper cables or, pluggable optical modules to move data back and forth between the processing chips.
Right. The standard physical wires.
Exactly. But as these artificial intelligence models require just exponentially more computing power, copper simply cannot move the data fast enough over long distances, not without requiring massive amounts of power.
And generating heat, right?
Catastrophic levels of heat, yeah. The data centers are essentially melting themselves, trying to push these electrical signals through copper.
Wow. So the data is bottlenecked because the physical wire is literally hitting its biological limit, so to speak.
Which is exactly where co-packaged optics comes in. Because CPO, it fundamentally changes the whole architecture. Instead of pushing electrical signals all the way across a motherboard to some separate optical transceiver.
Which takes time and energy.
Right. Instead of doing that, CPO takes the optical engine, which is the thing that turns data into light, and packages it directly onto the exact same piece of silicon as the processing chip.
Oh, wow. So they're combined.
Yeah, you're bypassing the copper highway almost entirely. You're moving data via lasers directly from the brain of the computer.
That's incredible. So it must save a ton of power.
Oh, it drastically reduces power consumption.
Yeah.
Slashes latency, and it allows for the kind of dense, super high-speed data transfer that the next generation of AI literally requires.
Okay, so that brings us to the timeline the CEO is boldly projecting for this tech. Because, it's not just the $91 billion destination that feels surreal here. It's the speed.
The speed is the craziest part.
Right. Our sources map this out very tightly. The TAM is expanding from, like we said, close to nothing up to $91 billion. And the window they are giving for this is the second half of 2026 to 2028.
It's right around the corner.
It is. But in the exact same breath, the CEO notes that this technology is, quote, very much in its infancy. Like the notes literally say we're at the beginnings.
Yeah, and the juxtaposition of the word infancy with a 2026 delivery window, that's really the first major tell in this transcript.
No, so.
Well, In the world of hardware manufacturing, hitting a $91 billion run rate by the second half of 2026 means the heavy lifting has to be completely underway right now, today.
Wait, okay, but let's look at the flip side of that, right?
Mm-hmm.
If the heavy lifting is happening right now, why use the word infancy at all? I mean, isn't that just a convenient way to buy time if they miss their targets? Like if you tell investors, hey, we're just a baby, they aren't going to expect you to run a marathon tomorrow.
I mean, that's a fair assumption if we were talking about software, right?
Yeah.
Where you could just push an update over the weekend to fix a bug.
True, true.
But hardware, specifically this kind of photonics and silicon manufacturing, it requires literal years of lead time.
Because of the physical supply chain.
Exactly.
Yeah.
You have to secure agreements for highly specialized materials. You have to build out clean rooms, run prototype testing, lock in fabrication plant capacity.
Yeah.
All of that takes years.
Oh, I see.
So when a CEO says infancy in the context of a 2026 $91 billion projection, they're definitely not talking about their internal engineering.
They're talking about what we can see.
Right. Public visibility.
Yeah.
The public market is only just now getting a peek at the technology. But behind closed doors, the industry is already in an absolute mad scramble to build this infrastructure.
So the fuse has already been lit in the labs and the fabs, and the public is basically just, waiting for the explosion to become visible.
Exactly.
Which really leads to the core question for you listening to this. How does a market actually capture $91 billion in revenue that fast? Because, even if the tech is brilliant, markets don't scale vertically just because a product is neat.
No, not at all. It requires extreme friction.
Right. Like you only see growth charts that look like hockey sticks when there is an overwhelming structural bottleneck.
The market basically has to be starved for a solution.
Yeah. And let me actually read the direct quote from the transcript here, because this is where we have to translate some pretty heavy corporate speak.
Go for it.
So the CEO states, quote, I think what we've said is that we will have a massive supply-demand imbalance on CPO. And the corresponding internal note just explicitly says demand is greater than supply.
A massive supply-demand imbalance. In corporate communications, that kind of phrasing is incredibly deliberate.
Well, here's my problem with that logic, though. To me, massive supply-demand imbalance sounds like this very sanitized, polite Wall Street jargon.
Oh, it totally is.
Right. Like when a CEO drops that phrase in an environment where demand is entirely eclipsing supply, aren't they really just using a calm indoor voice to announce an absolute chaotic shortage?
Yeah, they are basically pulling the fire alarm in a very, very measured tone. Because when demand violently outstrips supply in a market that's scaling to $91 billion, you're not talking about, like, a mild inconvenience where your shipments are delayed by a week.
You're talking about panic.
You're looking at existential bidding wars. Companies are going to scramble and pay massive premiums to secure this tech.
Because they literally have no other choice.
Exactly. If they don't have co-packaged optics, they can't run the next generation of AI models efficiently. And if they can't run those models, they just permanently fall behind their competitors.
Wow. So it is an absolute arms race. And the CEO is just casually mentioning that, hey, they basically own the only factory making the armor.
Yeah. Which is what makes the next section of the transcript so revealing. It addresses exactly how they are handling this impending shortage on their actual balance sheet.
Yes. Okay, this is the admission that completely caught my attention. So in discussing this massive imbalance in this coming supercycle, the CEO says, quote, look, that is not in our numbers, right? It is very, very significant.
Not in our numbers. That might honestly be the single most important string of words in this entire source document.
Okay, I want to push back hard on this. How is that even possible?
Well, I know, it sounds crazy.
We are talking about a trend the CEO admits is, quote, very, very significant in a market that is rocketing to $91 billion. How do you legally, or even logically, leave the biggest growth driver out of your official financial models?
Yeah.
Doesn't that suggest that this entire supercycle is just like highly speculative hot air? I mean, if they truly believe the math, wouldn't they put it on the spreadsheet to drive the stock price up today?
It seems totally counterintuitive, I know. But leaving it out of the numbers is actually a hallmark of high-level corporate game theory and SEC compliance.
SEC compliance, how so?
Because official financial models like the forward guidance that companies legally release to Wall Street, They have to be highly defensible. They're built on historical run rates, highly predictable recurring revenue, and signed, sealed contracts.
Okay, so it's about playing it safe.
Exactly. You cannot responsibly put a chaotic, unprecedented $91 billion supercycle into a conservative Excel spreadsheet. If the timing shifts by even a single quarter, you risk massive liability.
Oh, so they are legally bound to play it safe on paper.
Yes, but verbally, right.
Right.
On this call, the CEO is stepping entirely outside of that spreadsheet. They're giving this massive wink to the audience.
Like a secret signal.
Totally. They are saying, hey, the reality on the ground is so significant and the demand is so intense that our official conservative models can't even capture it yet. It's basically a form of sandbagging.
Sandbagging.
Right.
You set the official expectation low with your formal numbers, knowing full well that this unmodeled CPO demand is just, like, lurking off stage, getting ready to blow those official estimates totally out of the water.
Exactly.
You know, it also feels like a competitive smokescreen.
Oh, absolutely.
Because if you don't put it in your official numbers, your competitors might underestimate how fast you are actually moving behind the scenes, right? Until it's just too late for them to catch up.
Yeah, that is a crucial secondary benefit. It keeps the cards close to the chest while still legally signaling to those really savvy investors that a massive wave is forming.
Wow. Okay, so let's follow where the actual money is moving within this wave, because just knowing there is an unmodeled demand imbalance, I mean, that's only half the battle.
Right, we have to look at the structure.
Exactly. We need to look at how this supercycle is structured financially, and the sources draw a very deliberate line between two phases or applications of this technology. They call them scale out and scale up.
And the distinction between scale out and scale up, I mean, that is the entire architecture of the $91 billion projection. If you don't understand the mechanical difference between those two concepts, you really cannot grasp where the real revenue lies.
Okay, well, our notes tell us that the company has already seen, quote, multi-billion-dollar orders coming in mostly on scale-out.
Yeah.
And then the CEO explicitly pivots to scale-up CPO, calling it the, quote, largest single growth driver.
Right.
They actually project that scale-up will be, quote, significantly more than that in terms of revenue opportunity, specifically noting it will be somewhere greater than $5 billion.
Right. So we really need to define how those two networks function to understand why one commands a much larger premium than the other.
Please do.
Think about how you'd solve traffic congestion in a massive, rapidly growing city. Scale out is basically the equivalent of adding more lanes to the existing highway system.
Okay, so just building it wider.
Exactly. In a data center, scaling out means connecting hundreds or even thousands of separate individual servers together so they can share a workload.
Okay.
And co-packaged optics just helps those disparate servers talk to each other faster over longer distances across the building.
So scale out is connecting the individual boxes in the room.
Right.
And they already have multi-billion-dollar orders for that highway expansion.
Yes, but scale up solves a fundamentally different and honestly much harder physics problem. Going back to our city analogy, scaling up isn't just adding lanes to the highway.
What is it?
It is building a high-speed, frictionless bullet train system overhead. In the data center, scale-up is taking multiple highly advanced processors and connecting them so tightly with such high bandwidth and low latency that they basically operate as if they are one single massive superbrain.
Oh, wow. So you aren't just connecting separate servers across a room anymore.
No, you are fusing processors within the same localized pod to act as a unified giant.
That's wild. I mean, the technical difficulty of building that bullet train must be astronomically higher than just, pouring more concrete for a highway lane.
It's a totally different ballgame. It requires a fundamentally different level of optical density, power efficiency, and precision. And because the engineering barrier to entry for scale-up is so high, it commands massive premiums.
Which explains the revenue difference.
Exactly. That is why the CEO identifies scale-up as the largest single growth driver. Scale-out solves the problem of distance. Scale-up solves the problem of computing power limits.
Okay, so let's look at the rhetoric the CEO uses when presenting these two phases, because to me, it feels like they are building this psychological staircase for the listener, right?
Psychological staircase.
Yeah,
Right.
like they casually drop the fact that they already have multi-billion-dollar orders for scale out, and then they immediately follow that up by saying the scale-up opportunity is going to be significantly more than that, somewhere greater than $5 billion.
Right. They are using that first data point to basically force you to believe the second data point. By proving that the multi-billion-dollar scale-out orders are real and that they're already on the books, The CEO is establishing absolute, unshakable credibility.
Right. It's like, hey, we already cashed the check for the highway, so you can totally trust us when we say we are building the bullet train.
Precisely. The scale-out orders are essentially the proof of concept for the broader market. Once you, as an investor, or even a competitor, accept that the initial phase is validated and the money has literally cleared the bank, you're primed to digest that much larger, more ambitious scale-up projection.
Okay, well, let's dig into that greater than $5 billion number for a second. Because if the total market is heading toward $91 billion, why is the CEO anchoring their specific scale-up projection at just greater than $5 billion?
Right, it seems low.
Exactly. Is $5 billion the ceiling, or is that just the floor they are comfortable admitting to right now?
It definitely acts as a highly conservative floor. Think about it. If you tell the market you expect to capture the entirety of a $91 billion TAM, you sound totally delusional.
You lose all your credibility.
Completely.
Hmm.
By stating it will be significantly more than the multi-billion scale-out orders and putting a $5 billion baseline on it, the CEO provides a tangible, realistic milestone.
He grounds the math.
Yeah, it gives analysts a hard number to work with. Meanwhile, the phrase greater than leaves the door wide open for this explosive upside as that massive supply and demand imbalance really kicks in.
It really is a masterclass in managing expectations while simultaneously blowing them out of the water. Like, they are pointing to their conservative numbers while practically shouting that a chaotic shortage is coming that, isn't in those numbers at all.
It proves why looking past the official financial guidance is so vital. If you only read the quarterly reports and you only looked at the officially modeled spreadsheets, you would completely miss the architecture of this entire supercycle.
You'd be looking at the highway while the bullet train is being built right above your head.
Exactly.
Man, we have covered some incredibly dense ground today, and I really want to bring this all back to you, the listener, and why this matters for how you view the market. We took a few lines of insider notes and a short transcript snippet about this entity, LITE, and from that, we decoded the mechanics of a looming $91 billion shift in how global data centers are actually built.
Yeah, we moved past that whole illusion that this technology is in its infancy and revealed the reality of an impending violent collision between supply and demand.
Right? We unpacked the physics of co-packaged optics, explaining how moving data with light solves the melting point of traditional copper. We explored the financial game theory of a CEO deliberately leaving massive trends out of their numbers to, manage expectations and legally navigate SEC guidance.
And we broke down the vital mechanical difference between those scale-out highway expansions and the massive $5 billion plus scale-up bullet trains, which are going to act as the true growth driver here.
Yeah. Understanding the distinction between those technologies and the timeline required to deploy them, it gives you the ability to spot structural market shifts long before they show up on a mainstream balance sheet.
It gives you the decoder ring, really, to understand what executives are actually saying when they hide behind polite Wall Street jargon.
It does. And as we wrap up this deep dive, I want to leave you with one final lingering thought to mull over, something that builds directly on the reality of this impending bottleneck.
Because the ripple effects of a supercycle are rarely contained to just the companies building the technology.
Exactly. Think about the broader ecosystem. If the CEO of LITE is already seeing multi-billion-dollar orders during the supposed infancy stage, and they are explicitly bracing for a massive supply-demand imbalance between 2026 and 2028, what happens to the secondary players?
That's the real question.
What is going to happen to the vast network of software companies and cloud providers and AI startups relying on this massive increase in computing power if they are the ones caught on the wrong side of that shortage?
Yeah.
When the music finally stops and there simply aren't enough optical chips to go around in a $91 billion room, who gets left standing with obsolete copper? Keep your eyes open, keep reading between the lines, and we will catch you on the next deep dive.